we can just stand a little close to each other and you can talk into my
I'll speak into a lapel. Good afternoon, everyone. All here, ready, wait. Don't let that stuff you ate slow you down now. This is important stuff. My name's Ranger Kidmore Ross. I'm the editor of WorldSweeper.com, Earth's largest power sweeping resource, and director of the World Sweeping Association. And it was our pleasure today to sponsor Mark here with this very important information. You should always run your business like you're ready to sell it, and Mark's going to tell you how to do that. He is the founder and CEO of Pursant LLC, which is an investment bank helping middle market business owners optimize the value of their businesses, manage strategic transactions, and orchestrate liquidity events. Prior to founding Pursant, Mark was a serial entrepreneur, buyer, and seller of business, having bought, sold, and operated over a dozen companies on his own and advised on countless strategic transactions in numerous sectors, including this one, the pavement maintenance sector. His businesses employed as few as a dozen people and as many as 1,400. He grew his companies through acquisitions, strategic divestitures of divisions, and managed organic growth. The businesses operated at local, regional, and national levels. Now, that covers pretty much everybody in the room, doesn't it? He's been there, he's done it, and he's been very successful at it. During his time as an operator, he's found that to best grow enterprise value, it is necessary to become proficient at optimizing company performance and executing strategic transactions. He honed his skill in these areas and in 2009, 10 years ago, founded Pursant LLC. Today's session, preparing for and executing a successful M&A transaction. You should know there is a flurry of M&A activity in the middle market and pavement maintenance sector right now. And in the event you decide to embark on one of these strategic transactions, you're going to learn how to maximize your chances for deal success. Learn what are the macro level and industry specific drivers of valuation and what the common deal terms, structures, processes, timelines, and other key metrics are that you need to know. During this seminar today, Mark will review the current state of M&A in the middle market, and he will provide you with the facts and insights you need to know in order to prepare for and effectively execute an acquisition or business sale. And with that, I give you Mark Herbick. Let's give him a round of applause.
I think we're out of time now with that. Questions. No, so thanks for coming to the session. I know you got a lot of choices when you're coming to this event, including at this time slot. And people are wondering what to go to. And I personally feel this is the most important session for business owners to go to. There's a lot of valuable sessions, but when you think about why you got into business and the fact that for most people this is the only business you'll ever own, thinking about what it's going to look like when you exit your business is just absolutely critical, because it's the most valuable asset most people will ever have is their business. And a lot of people think, oh, I don't necessarily want to sell, one of my kids will take it. And I tell you, statistically, there's only an 11% chance today's generation is going to come into a legacy family business. It used to be a couple generations ago, it was, if you still wanted to live here, you needed to come into the family business. And that has changed quite significantly. So the youth not only do not want to come into the family business, but they also don't want to come into a pavement maintenance business. It's not exactly what they had in mind. They may rethink that later on down the road, but at present time, that's kind of where it's at. So when you think about your options, if one of your children's not going to step into the business, you really have to sell and close the doors. And hopefully you're not going to close your doors. You have something that you've built that has value. So everything we're going to talk about is very relevant, maybe not for you today or this week or this month or even this year, but at some point in your life. And the other thing is a lot of best practices for what happens with buying and selling companies. Those are really timeless. Certainly the marketplace changes, the condition of your business is going to change, but what we're going to talk about can be applied now or it can be applied much later. So, Ranger gave you a little bit of background on me. Let me just build on that briefly. I promise it won't take as long as the content that I gave Ranger. So I started as a serial entrepreneur when I was 18 years old. My first business at high school was a fitness center, and I went on to open other fitness centers after that. And I got my first acquisition under my belt when I was 20. And then I got my first real non-sexy business. I always wanted to get into the fitness center industry because I just thought it would be really cool, and I figured out it's a lot of hard work, and it's not entirely profitable. It's very non-recession resistant, and it's tough to make it in that space. But I bought a building maintenance company when I was 27 years old. I was chasing recurring revenues. I was chasing recession-resistant sectors, and that was my first acquisition. I went on after that to buy a bunch of other businesses that were very complementary to the facility services sector, did a number of divestitures along the way, and some of them were very small, and some of the businesses operated at a national level with over 1,000 employees. So I got to see the complexity of having 5 employees, which I can tell you is equally as hard as having 1,400 employees. It's just a different kind of hard. And I also got the joy of seeing those liquidity events and also going through the emotional roller coaster that's involved when you're buying and selling a business that you've built. I started advising on strategic transactions like M&A and raising capital about 15 years ago, mostly for people within my professional network. And when I exited my own operating portfolio of companies in 2007, it became my full-time passion. Our firm was born in 2010. Today, we have 3 business units in Pursant. We have one business unit that does investment banking, which is essentially advising on M&A transactions, both on the buyer side of the table and on the seller side of the table. We have a strategic transaction support side of our business, which does essentially business valuation, due diligence support, and also some post-transaction integration-oriented work. These are for transactions that we weren't representing the buyer or the seller, but parties wanted to bring us in to help us do some other heavy lifting. And then the third side of what we do is a business value enhancement practice where we're working with business owners that are a few years out from selling their business and want to prepare it. Actually, one of the gals just walked in here and then she left, who I met at Pavement Expo a few years ago. We came in and we advised her on how to increase her enterprise value, and she just closed our transaction January 1st of this year. Very excited about that for her, and that we were able to help her. So that's a very quick overview of what we do. So again, my background, I come from the perspective of having to deal with a lot of the same challenges that you deal with as a business owner, but I also have, through myself and our firm and our team, exposure to a variety of different deals. And Ranger asked me what a typical day is, and for me it's deals all day, and moving from engagement to engagement that we're working on, revising strategy, and just keeping all the balls moving down the field. So our discussion today, so first I'm going to give you a very quick overview. I'm not an economist, but I am going to talk a little bit about the macroeconomy and how it affected mergers and acquisitions last year and what you can expect this year. Because when we're thinking about doing a deal, whether we're a buyer or a seller, I don't want to think about everybody in this room as a seller, because I know a couple of people aren't, they're buyers, at least a couple of people here. When you think about the best time to do a deal, you really want 3 things to line up. You want the market overall to be favorable to M&A. And that is oftentimes driven by the macro economy. You want to be ready personally as a business owner to do this, because whether the economy is great or not, if you're not ready to sell your baby, then it's going to be a real tough thing for you to go through. And thirdly, you want the business to be in the right spot. So I can share information regarding number 1. I can help you with number 3 on how to get your business positioned properly. I cannot do anything about your emotional state of mind, and whether you're ready to transact. I can refer you to people, but that would be me. So we'll talk about that. My discussion, as we're talking about this today, is not going to be consistent with what you hear on CNBC. So I'm talking about deals that have enterprise value of less than $250 million, and even more specifically, transactions that probably have less than $100 million. That's considered the lower middle market. These transactions are not regulated. The data out there on how many of these types of deals get done and the multiples of terms and everything, it's all pretty much worthless because the transactions aren't regulated. These deals go on every day, and there's really not good visibility into like a database that has really good solid data. So what it requires is firms like ours and other firms to really keep their ear to the ground, to listen to what's going on, to engage with people like yourselves, talk to people like Sylvia that was in here. How did your deal go down? What are the terms? To get the real scoop on what's happening in the marketplace. So we will be talking about smaller deals. So hopefully that I can make it relatable for you because it's very different than what happens on Wall Street. I'm going to talk about why preparing for a sale now, starting now, is really important. It doesn't matter when you're going to sell, because the best practice for sale preparation are also the best practices for running the business as profitable as you can get it with the least amount of stress. Be surprised how much of those two outcomes line up very nicely. And we'll talk about drivers of valuation and deal structure. We'll talk about not only deal structure, but timelines and things like that. I'll give you some other metrics of what you could expect. So if I decide I'm going to do this, what should I look forward to? How long is it going to take? What are the chances I'm going to close? There's actually some pretty good data on those types of numbers that I'll share with you during the process here. And I'll talk about what to expect in 2019. So let's jump into it. So for 2018, if you looked at the overall market, people say, how's M&A doing? The overall market for the M&A universe was up anywhere from 10% to 50%. So wow, that's a really big range. It's because, again, a lot of these transactions, if they're not a publicly traded company, are unregulated. So getting a good handle on whether the year was up or the year was down is really hard. So you look at 20 different reliable sources and you try to find some common themes. So the sentiment across the board is that overall M&A was up in 2018 compared to 2017, which is good, and also early indications are that 2019 M&A is up. So there's a positive deal vibe going on in the marketplace. Now, that being said, when we bring it back down to our level, so small business, lower middle market, the volume largely unchanged from 2017 to 2018. And the reason is there's different drivers for M&A for these big deals you see on CNBC versus drivers of sales of companies at the lower level. What drives a sale at the lower level is normally somebody entering retirement and people that are looking for the next opportunity, or they're burnt out of their business. That's very different than what happens for very, very large upper middle market or publicly traded companies. And those things, burnout, retirement, and seeking new opportunities, it doesn't really change, regardless of the cost of capital, whether Wall Street's up, Wall Street's down. I'm still burned out, and so I'm still going to sell. So you'll see that in the lower middle market and small business world, there's not a lot of big swings in any one year, up or down. There are certainly major events like the large recession we had in 08 and 09 that will crush M&A activity across the board, but absent something like that, it still pretty much plods along. It doesn't change a whole lot from a volume perspective. Again, regarding average age, we got 10,000 baby boomers retiring a day. And a lot of those are small business and lower market business owners. Again, 100% of the time the kids want to come in, you're not going to live forever. That totals up to, you got to sell your business. So there is, and that's really, there's going to be a lot of supply of businesses available in the marketplace because of that baby boomer phenomenon going on. The other thing that drove M&A is it was a very favorable environment out there from a tax perspective, from a policy perspective, and just the administration in general. And there was a little more certainty. During major election cycles, M&A tends to maybe slow down a bit because of a little uncertainty about what's on the horizon and how that's going to affect whether or not I should buy this business or not. Limited organic growth options. So people are chasing top line growth in some sectors, especially like in the facility services sector. Unless there's a massive surge in the number of new facilities, then if you want to grow top line and you're a larger business, then you're resorting to buying other companies to do that. It would open up new markets. There are certain sectors like mainline paving that are more subject to the spending that happens at the state and the federal level with roads and everything, which are much more cyclical. Whether Target or Walgreens or commercial office building does, any sort of resurfacing or seal coating, crack fill, I mean, those kind of things continue to happen on a regular basis and tend to swing a lot less up or down. So if you want to pick up big surge in new business, you usually have to resort to making acquisitions because there's now new buildings popping out of the ground to make up for it. Valuation multiples. We'll take a deeper dive into this, but the consensus is if you were ever going to sell your business, now is the optimal time to do it. Nobody is disagreeing, meaning it's not going to get any better. It's only going to soften. Doesn't mean it's going to go from good to bad, but it's not going to be better. And we'll talk about why that is. With that, we did see due diligence a lot more rigorous. People are paying premiums for businesses. It's like, if I'm going to pay you that much money for the business, then I'm going to put you through a lot of pain in the diligence process to make sure that this is exactly what you're representing to me. So be prepared for longer processes of due diligence and be prepared for it to be painful. Stress testing, optimization, and exit planning. A lot of people calling us up saying, hey, I'm not ready to do a deal now, but can we do like a trial run? Can you come in and diligence my business, point out all the things that somebody else is going to come along and point out during a sale process, and then going to beat me up on my price because of all these things. So let's do the bidding now while nobody's watching. So they'll have us come in and just kind of work. We're seeing more and more of that. Private equity, they have, so you got basically two buyers out there, and it's the strategic. So somebody who's already operating a business like yours or adjacent to yours right now, or you've got a financial buyer, somebody that may or may not have a business like yours, but they're looking to acquire one. They have a boatload of capital that they've raised, and they need to buy companies to put that money to work. So, it used to be that they could say, well, our minimum deal size is $5 million in EBITDA or earnings for your business. And more and more private equity groups are saying, well, we'll go less than $5 million. There's many who will say, well, we've got a $3 million EBITDA deal that's below your $5 million threshold. And well, we'll do that too. Okay, well, we actually got 1.5 and $2 million ones. Well, we'll look at those also. So they're continuing to move down the food chain into smaller businesses because they really need to put the capital to work. And lastly, we've got this phenomenon we've seen happen more and more because of the low unemployment out there right now. And people are looking at businesses that in the past they would have just maybe not paid much attention to because there's some issues with the business. Maybe it wasn't perfect client base, maybe it wasn't very profitable. But with the shortage of talent out there right now and low unemployment, we're seeing people do deals just to acquire their people. And then they're re-engineering the business and eliminating customers in many cases to redeploy those very valuable people, specialized people, into roles in their company. So an acqui-hire is just acquiring the business so they can hire your people. And that's how tough it is in today's marketplace for a lot of talent. So that's kind of a very quick snapshot of 2018. As we're going through, you can ask questions if you want. Otherwise, ask at the end. So I'm trying not to dwell too much on any one thing, but that's a very quick snapshot of 2018. So if we start at the very 30,000 foot level and what's going on that is driving M&A activity out there, these are the main 5 variables or metrics, if you will, indicators that we look at when we're trying to figure out where is M&A going and is sentiment going to be positive or negative in the near future and why deals are happening. Because what happens at 30,000 feet ultimately kind of rolls down to the ground level eventually. Nothing stays up there that long. So one of the things we look at is GDP. We all see this number on the news and everything else, but what it relates to M&A is the correlation between strong GDP and just good overall M&A sentiment. People are happy, business is going well, the economy's on track, and it's kind of like I'm up at Vegas and I feel like I do a little more betting here. So I'll do some M&A. So there is a relationship between GDP and M&A volume. And businesses generally are healthier. And certainly there's some negatives to GDP growth, but for the most part businesses are healthier. So unemployment, this is, people are getting desperate for talent. I mean, when I go to events like this and I talk to people and ask them about their number one challenge, normally it's, I can't get good people. So we are seeing that phenomenon of, I'd like to hire that company, I'd like to buy that company because they've got some really good people that I can really benefit from. And, they're profitable and there's a lot of other value, but people are starting to voice this now as a benefit to doing M&A, is picking up good people, especially leaders. It's really hard to buy a business and get the leadership, that top level person, and if you convince the owner to stick around post-deal, and they're actually employable. I think I made that statement earlier. A lot of business owners just, they don't play nice with others. That's why they own a business rather than working for somebody else. So as long as you're employable and you can play well with others, then there's a huge opportunity for buyers, in those types of scenarios. So another thing we look at is certainly inflation. It has a relationship to interest rates, which is the next slide here, which drives the cost of capital. So people borrow money to do deals. There's a common misconception out there that if somebody buys my company, they're going to pay cash. And the reality is most people borrow to do it, even though they don't need to. So not only are they borrowing from their senior lender, their bank that they have their relationship with, but they're also pulling more expensive capital from mezzanine type lenders. Well, if you're going to borrow to do deals, you're going to factor in cost of borrowing that money into the cost of you doing this deal. And if interest rates start to go up, it costs me more to do the deal. And as interest rates go up, there's also, I'm going to potentially even not do a deal if it gets too high. Now I will say, if you look at right now, we've got a Fed funds rate about 2.5. If you rewind back to about 12 years ago, it was at 5.25. And you're like, wow, that's a ton higher for me to borrow money. But if you look at the volume of deals going on, it didn't really change. It's about the same as it was pre-recession. But certainly the valuations are down back here compared to here. And part of that is because of the cost of capital out there. So the other thing we're looking at, and keeping a very close eye on, if you're following any the more well-known macroeconomists, you're hearing this as well. There is all those other slides really have to do with what kind of the trends that always have an ebb and flow. Unemployment's going to go up and down, interest rates are going to go up and down, GDP's going to go up and down. It's kind of very predictable trends to that kind of stuff. What you're looking for is what's the next bomb that's going to go off? What's the next 08, 09, which was triggered by the housing situation. Well, the next bomb is, it's been lit and their fuse is going right now. And the consensus is it is a credit bomb, but it's geared more towards the corporate world than the consumer or residential world like we had back in 08, 09. So if you look at the amount of global indebtedness, right now it's at $70 trillion. If we rewind back to 2007, so a little over 10 years ago, it was at 43 trillion. So this is non-financial corporates, government, household. You see household debt, it's gone up, but nowhere near as much as corporate debt. So there's no secret to the fact that people are borrowing tons and tons of money right now because it's super, super cheap. So The other thing we look at is, if you take a look at bonds. So bonds are another way of funding the debt world. And if you go back to 2009, about 32% of triple B rated bonds, that is the lowest investment grade rating there is for a bond. If you got re-rated one tick lower, you fall into junk status. So roughly a third of them fell into the fell into the triple B status 2009. Right now we're up close to 50% of them. So there's a lot of stuff up there now that is one tick better than junk status. So again, another indicator that the quality of the debt out there is not as awesome as it used to be. And even if you look at loans, so go back 10 years ago, 9 years ago, 5% of loans in the US were what we call covenant-light loans. So people say, well, what's a covenant-light loan? It's exactly kind of how it sounds. If you go to borrow money from the bank right now, they're going to put in all these debt-to-equity ratios and these requirements you have for them to think you're in good shape and you're going to be able to pay your debt. And what's happening is now 75% of total loans that are issued are covenant-light loans, which means there's a lot more, it'll be fine, we'll waive these covenants, we'll reduce these covenants, which is, again, think back to the housing crisis, when people were buying homes they couldn't afford, when verifications of income and everything else kind of went out the window. So there's behaviors in the marketplace, which are not unprecedented, by the way. Human beings have a nasty habit of repeating stuff, like every 10 years or so. So when you roll all that together, I'm going to go through this slide. If you roll all that together, so these are kind of four things that make up that discussion I just had. The stage is set for the next big bomb that's going to drive a major recession, and it's going to be a credit bomb, and it will completely change the M&A environment. You say, that's awesome, there's always some sort of bomb going out there, but what would be really helpful is if you tell me when it's going to go off. So that is debatable. Some very knowledgeable and well-respected macroeconomists are saying it's a year away. Some are saying it's a couple of years away. There's not many people that are going up past a couple of years. So I share this not to say, hey, when you run out the door, go sell your business. I share this because, again, if you go back to the 3 times when it's best to sell your business, it's when the market's favorable, when you're in a good place up here, and when your business is in good shape. If you're thinking about, well, I'm going to wait 18 months to sell my business, I would say don't wait 18 months. Unless your business is going to materially change. Not like, let's say this never happened. The taxation environment is not going to be any better 18 months from now than it is right now. The overall M&A environment and multiples and things like that, because interest rates will continue to go up, is not going to be as favorable. There's not a lot of sound logic to waiting 18 months. Now, if you said, I'm not ready to sell for 5 to 10 years, then you're probably okay. But if you were debating whether to do it now or just a little later than now, I would encourage you to do it sooner. Again, not just because of this. Valuations are at a high. The sentiment is running really strong. People are up. So this is something I wanted to share with you as we're thinking about, if I don't want to sell the business. I get the question. When somebody says, well, I don't want to sell all of it, what if I sell part of it? It's like, well, what does that really mean, sell part of it? I mean, do you want a partner? Do you want to take some cash out of the business? So there's a couple different paths that you can go if you want to take some of the equity out of your business. Some people will borrow the money. They'll go to the bank and they'll say, I make $500,000 a year. I want you to give me $1 million to $1.5 million as senior secured loan, which you could get. Banks are lending anywhere from 2 to 3 times the EBITDA of your business, and they're going to charge you somewhere between kind of 3 and 5% if you want to pull that money out of the business, as long as obviously the business can support that debt. Maybe you wanted to redeploy that money and go out and buy companies. So that's a very common thing. People are borrowing money at 3 to 5% to go out and buy a business. If you went to an asset-based lender, the rate's going to be higher. If you went to a mezzanine lender, you're looking at rates that are somewhere in the teens to borrow money to either do deals or take some equity out of your business, take some of the cash out of your business. The other option you have is certainly selling some of your stock. So somebody who's going to buy a portion of your stock, either the majority of it or the minority of it, so think about private equity partner, these are the returns that they're going to be thinking about when they enter this relationship, which essentially translate into your cost for giving up that stock in the business. It's the equivalent of paying a 20 to 30% interest rate, because that's the return that they're expecting. This doesn't really apply to anybody else in this room, at least in this sector. Venture capital and angel investors, that's kind of returns they're looking for. But there certainly is the option of taking money out of your business in lieu of selling it. And you'll get all these slides afterwards. What you have as a handout is a different tool, but you'll get all this afterwards to refer back to. So we'll run through some of the things what you can expect if you decided now is the time that I'm going to sell the business. So this particular piece of data was pulled from the Pepperdine Private Capital Markets report. Pepperdine University, they do one of the best jobs there is of aggregating this kind of data for smaller transactions. So specifically transactions of less than generally $100 million in enterprise value, all the way down to companies that trade hands for a few $100,000. So we found this is very consistent with what we see in the marketplace. So if you had a deal, for example, that the value was less than $500,000 for selling your company, from the time you went to market and said, I'm ready, I've got my materials, my finances are all buttoned up, I'm going to start talking to buyers, you can expect about a 6-month process. From the time you get an LOI signed, you can expect it to be a couple of months. Again, very small deals. So you can see what happens when you get into bigger check sizes. So the complexity of the deal changes when the enterprise value goes from, call it in this case, 5 to 50 million. You should plan for a year. So a lot more people you're going to talk to. The negotiations, the relationship building, it all just takes longer. The due diligence takes longer. Negotiating definitive agreements takes longer. So it takes plan for a year and plan for that year to feel like 5 years. Deals they're like dog years for the seller. It's just it just goes on forever, and it's painful because it's an emotional process. This isn't just an asset. This is something that you put your life into. You barely saw your kids because you were building it all the time. You may have gone through a spouse or two because you put the business first. I mean, you paid your dues, so it feels extra painful when you're going through the process. That's why it's emotional. So then I'm going to go through all that work. We're actually going to close. So typically, again, this is for smaller deals. And the good news is about 75% chance you're going to close. And if you're not going to close, it's generally going to come down to one of two things. It's either going to be a price gap. That kind of gives you the breakdown here of, well, how big is the gap typically? 35% of the time it's a 1 to 10% gap. 35% of the time it's an 11 to 20% gap. And balance, obviously, the gap's even bigger than that. Or there's an unrealistic demand that buyer is requiring that we just, or that the seller's requiring, that we just can't agree on. And that could be anything. It could be, the most common one is how much, if you're not going to receive all of the purchase price in cash, over what period of time are you going to receive the remaining consideration, and what are the hurdles that have to be met in order for me to get that? There's a lot of discussion around that particular point, and that's where deals often break down, is how much is cash versus non-cash. This is again, talking about the two different parties out there, whether you're going to sell to a strategic, so somebody who has an operating business, or somebody who's a pure financial buyer. They don't have a presence in the space, or maybe they do have a presence in the space and it's in the form of a platform company and they're seeking add-on acquisition. If you look at the data, the data says that the vast majority of the time, the strategics are going to pay more. So, here you're looking at 78% of the time, a strategic is going to pay premium over the financial buyer. And these are again statistically the premiums that are seen out there paid by strategics. Now I will tell you, and then 40% of deals involved through the Pepperdine survey involved a financial buyer as opposed to a strategic buyer. I will tell you that the deals that we see where we have bidders that are both financial buyers and strategic buyers, the gap is getting very, very narrow. Financial buyers are really starting to step up and try to get, they're trying to buy businesses very aggressively, and they're paying more to get competitive with the strategic. So that gap is narrowing. In fact, this is a report every year. If you pull that slide up from last year, the gap was much wider as far as frequency that strategics were paying more than the financial buyers. So just something to think about. Why people are selling. So number one reason kind of across the board in the lower middle market is retirement. The average age is up there. The number two reason is either burnout or they're pursuing a new opportunity for the most part. I will tell you that I've dug a little deeper into this survey, and what I found is these two kind of go hand in hand. Meaning, I am burnt out and I'm going to chase a new opportunity. Rarely does one happen without the other. There's not too many people that are saying, I love my business, but I'm going to go do something new. It's awesome. I'm making a lot of money. I'm having a lot of fun. I don't want to do this anymore. I'm going to sell it. So we don't, it happens, but just not very often. So normally what happens is people are not of retirement age. They don't love what they do anymore, and they want to go do something else. In fact, in some industries, especially mature industries like this sector, we oftentimes do see the number one reason for selling is people are burnt out. It's not retirement.
Well, your first scenario, I love my business, I'm going to sell one to someone else. To me, that is a true entrepreneur.
Yeah, if you're a serial entrepreneur, that's what I do.
We call ourselves entrepreneurs, but really we just own our own company. But that's a true entrepreneur. He built it, now he's just going on to the next thing is new challenge.
That's exactly right. We see people that are just serial entrepreneurs, and that's their gig. They start businesses, they build them, they make them successful, they sell them, and they move on to the next opportunity. But the majority of the time, we see people moving on just because they're burnt out. So who are the buyers? Again, it depends on the size of the deal. So I'll run through this real quickly. Now, I won't go through each bar, but if you think about a first-time individual, so this is somebody who's retired from corporate America. I'm going to buy and operate a business because it's way cooler than working for somebody else. So half the deals that happen for these small deals, less than $500,000 in purchase price, are usually an individual. So you can see that blue line starts to disappear as the check size goes up. When you think about strategics, so that's the green bar right here, they're pretty much all across the deal spectrum. They're buying the little $500,000 tuck-in, and they're buying the $5 to $50 million large established business. When you think about private equity, they don't really exist until either an add-on or a platform. A platform is private equity's first acquisition in a sector. An add-on would be they've already got a company that they own, and they're just adding more companies on top of that. They don't really start to get active until, at least $1 million, but they're the most active buyers when check sizes get much larger. They have a lot of money. Right now, there's an unprecedented amount of capital out there that's called dry powder in the private equity world that needs to get deployed. So they're very aggressive. So when you're thinking about who do I sell my business to, this is good information to have. You think about the best buyer pools based on the size of your deal. So if I go to market right now, is it more seller favorable or buyer favorable? It's like if you wanted to sell your house, is it a seller's market or a buyer's market right now for housing? And the answer, it depends, and it depends on how big your deal is. So if you have a small business, then the power is still firmly in the hands of the buyer. Buyers are, there's a ton of small businesses for sale, And buyers are picking and choosing what they want to do. They don't do your deal, they'll do your deal. So it's still a buyer's market. As the deal size goes up, the buyer's leverage goes down and the seller's leverage goes up. So now what you've got going on, if you've got a business that can trade for $5 to $50 million, there's very few of you out there that have good businesses, good earnings, good people. All the boxes are checked, and there's tons of buyers chasing these types of handful of companies. So you are definitely in the driver's seat if you pretty much get there when you cross over that $1 million threshold. Yeah.
So, for example, is this a snapshot, or is this, even when the economy's doing a couple of changes?
This is right now.
Okay.
Yeah, this is right now.
Do they fluctuate much between the two, the seller or the buyer?
In good times and bad? Not generally. When you think about small businesses, again, there's so many. I mean, you could go on DealStream or BizBuySell right now. You could see a multiple listing service of all the businesses that are for sale. You won't see these types of companies out there because they're few and far between. So the availability, so there's always going to be strategics wanting to buy, and there's always going to be private equity looking to buy, and there's generally always a shortage of really good companies. And the shortage is even more so when the economy's bad. Companies can do poorly, and now it's even harder to find a business.
Valuation there is on sales volume, like $3 million per year sales.
Yeah, so this is enterprise value or check size. So if your business is worth somewhere between $2 million and $5 million, that's what you were to be paid for your business. This is what you could expect as far as who has a little more leverage in a relationship. So let's talk about valuations. A lot of data there about what to expect if you get into a deal. So in this industry, so I'll talk about the pavement maintenance sector. You've got to put on your paid hat because, again, if you listen to the CNBC Wall Street hat, people are trading for 1 times revenue, 2 times revenue, 10 times revenue. You're not Amazon. You're not. This is not the tech sector. It's not the healthcare sector. It's not a growing sector. This is a mature sector, asset-light, legacy-type business sector. So this is how valuation goes down in the pavement maintenance sector. So there's really 2 things you need to understand in order to get to a number of what you're worth. First thing you need to understand is what's called your EBITDA, and that's essentially your earnings, and those are adjusted earnings. There's a lot of adjustments that go into adjusting your earnings. You're going to pull out depreciation expense, you're going to pull out interest expense. If you've been remodeling your house and putting those expenses through the business, that gets pulled out. If you've got all the kids' cars on the business, that gets pulled out because none of that's going to continue for the buyer. So you're going to get to a number that me as a buyer can say, this is what I can expect coming out of this business now that it's been cleansed of all those non-business related activities. And if you're doing all that, somebody here may have raised their hand, all those things, it's okay, that's pretty common. That's one of the luxuries you have as a business owner. The second thing you need to think about is what's my multiple? So let's assume this is $1 million. Am I going to get $1 million, $2 million, $3 million, $10 million? What's my multiple? So your multiple is going to be driven by, let me go back to EBITDA for a second. So when you're thinking about the EBITDA or the earnings of your business, number 1, adjusted, we talked about that. Number 2, most people are going to be looking at the trailing 12 months. So what has been happening in the last 12 months? And that's usually going to kind of set the bar for that first number that's going to be used. The exception is if your business looks like this. If you have historically growing revenues and earnings, that starts to get factored into the discussion, especially if it's a very steep line up. Because the argument is, well, let's see, I made $250 last year, 500, or $250 2 years ago, 500 last year, and I'm on track to make $1 million this year. So why would I base it on $500,000 when I'm on a run rate of $1 million right now? And the answer is you don't have to. you can start having discussions about $1 million. It has to be defensible, it has to be sustainable. It can't just be you go out and win a new contract that all of a sudden doubles your earnings, and you say, well, I'm going to sell it off that. Well, that doesn't work because you need to show that it's sustainable. So run rate, as we call it, is another way companies are valued. What's their trajectory? Where is it going? And you can monetize, a good chunk of that run rate. So when you talk about the multiple, what drives the multiple is what we refer to as the risk profile of business. Your handout there, don't take the test now, but there's a 21 question little test in there that you can take that will help you get a handle on what the risk profile of your business is. But the risk profile is going to drive the multiple that's now applied to your business. These are the main profile drivers for the pavement maintenance sector. So number one, they're going to be looking at the type of customer you've got. Is it a customer that is a little more recession resistant? Is it a customer that is more relationship oriented? There's not a lot of appeal for residential customers. They tend to be very painful. Government work is a notch above that. It tends to be more difficult to sustain. It's often low bid. There's not anything wrong with it. When you're thinking about a buyer, what is the sustainability of this revenue stream and the complexity of this revenue stream and the risk associated with the revenue stream? You could be being massively rich off of government contracts, but a buyer is oftentimes going to view that very differently. Developers, the construction contractors, those are also less favorable because we all know construction's kind of up and down. What is the most desirable type of customer in this sector normally is, I'll call it commercial, that could be, homeowners associations, things like that, people that are going to have the work done on a recurring basis and people that you can build relationships with. So think about relationships, think about recession resistant, and pretty much revenue you can count on coming through, whether things are up or things are down, it's pretty much always going to be there. Yeah.
So, back to the other, and adjusting multiples, that sort of thing.
Yeah.
There's got to be some considerations of very rapid growth, north of 30% a year.
Mm-hmm.
But it doesn't leave you as much fun.
Right.
Like, investment's expensive. Right?
Yes.
Growth is expensive. So, would you just increase the multiple, trying to come up with an idea?
So I mean, if your earnings are compromised because of growth, it generally comes down to one of two things. Either you have you've made capital investments that you're expensing rather than depreciating. So it's ripped all profit out of the business. So there's definitely an argument to say we can adjust all that noise out. Or it's because you invested in people that have yet to pay off. So you went out and you hired 6 new estimators. They're all on payroll at $60,000. It's spring, work hasn't started yet. My earnings are down because of it. If you can show that, I used to have 6, now I have 6 more. 12 is a lot of estimators. It's a big business, but if you can show that the average estimator brings in $500,000, $1 million a year in revenue, and you can show how these people will pay for themselves, and that starts to pan out, then that's a defensible position for an adjusted earnings discussion. But we run into businesses that they've got overblown general and administrative costs, and it's eroded their earnings, and we say, hey, we can rip all that out. The business would be more profitable. So it depends on what you mean as far as we've invested in the business. If it's equipment, that's very defensively adjusted out. If it's people, it's a deeper discussion, especially if it's estimators. Does that answer your question? Yep. Okay, all right, got it. So percentage of new customers versus repeat customers, both are good. But if you've gotten your business to the point where basically the phone rings, an estimator picks up the phone and goes out and bids it, it probably doesn't have aggressive growth, so it's a little less desirable. But if you've got people out there pounding the pavement, seeking new relationships, and so you've got new customers coming in, and it's not just repeat customers, that's the ultimate scenario. You've got a nice, solid stable of repeat customers coming in every year or two, and then you've got new ones coming in as well because your people are out there drumming up new business and not just waiting for the phone to ring. Customer revenue concentrations. If you have these anomalies, you win these big jobs, and your revenue spikes. How do you find a spike? Anything that's a double-digit percentage of your revenue for a year that's not repeated is a spike, and a flag's going to pop up. It's like, well, is that really sustainable? Now, if you show that, well, every year we have one of those things, then that's an easier discussion to have. But we've had some businesses who say, well, I made $500,000 last year and I made $3 million this year. It's like, wow, what happened? Well, we won this one big job, so can I trade off of a multiple of $3 million? The answer is, well, no. You can't trade off a multiple of 3. Now, if you had that happen every year for the last 5 years, now you've got a defensible position. But it has to be sustainable revenue. It has to be revenue that when the owner goes to sleep at night, whether it's you or the buyer, they can sleep well knowing that, okay, if this event doesn't happen again, we're going to do what we did last year or better. Revenue and margin trends, this is pretty straightforward. You want those all going in the positive direction. Talent concentrations. This is one of the big flags that we see in a lot of smaller businesses. The owner has got this red cape on. He or she flies around doing everything. They're making sure that work's executed, they're making sure that deals are closed, making sure that the books are straight. And if they get, hit by a truck, then the business is really going to struggle to stay in business. That's also a business that's very difficult to sell. So whenever we're doing business optimization, usually one of the things that we're spending a lot of time coaching people on is you have got to be in a position where the business does not need you. And by the way, it doesn't need the guy next to you or her over there or her over there. It can continue as a precision team to move forward without its dependency on any one or handful of individuals. But this is one of the biggest issues. Is you're making a lot of money, but you're going bell to bell, and the business is totally dependent on you. It's not a sustainable situation. Equipment, quality, type, quantity, everything else. Scenarios here is, people have 10 million revenue, they have enough equipment to carry them to just 10 million in revenue, they've got no other capacity left on their equipment, and they put forward these projections and say, well, we can do 15 million next year, well, not without making these additional capital investments and thinking about that. Some people will say, well, I'm going to sell my business, so I'm going to shut down all the expense. I'm taking care of these things, and the buyer walks in and sees stuff, held together with duct tape and Band-Aids. And so there is an assessment of not only the quality of your equipment, but the capacity that you have that's unutilized. Because whoever is going to buy your business is thinking about what I can do with it and how quickly I can grow it. The quality of your earnings. So this is just simply, how are you reporting your information? Is it externally reviewed? Is it just you putting together? And is it all accurate? And it sounds like it's an easy box check, but it's very rare that all of those situations, all those conditions exist. So this gives buyers anxiety. This causes them to be more conservative in how they value the business. It also causes them to be more rigorous in their due diligence. So that's why it's a driver of the multiple range. So those are kind of the biggies. There is other ones, but those are the real big ones. We're generally revolving around customers and people in your business and your margins. Another thing to think about is there's a couple of wild cards out there. Just like when you're playing cards, these things have extra value that can be laid on top that just nobody else has. One of them is what's called a size premium. So if you are the dominant player in your market, that is going to bode very, very well for you when it comes to a multiple. If you have a brand that is the dominant brand in the marketplace, maybe it hasn't manifested itself to its fullest potential in the form of your financial performance as a business, but it's like, man, if I'm going to own a business in St. Louis, it's this one, because they have the name, they have a reputation, they have the size. Maybe it's not run as well, but there is definitely a premium that people pay for size. The other premium that they'll pay is what's called quality premium, which is reserved for businesses that have margins that are 10% or better than their competitors. So let's say that you had a $5 million company and you had a $5 million company. They both did the same thing, and you were both good customers and everything else, but you were making more money than his business. We're going to apply a higher multiple to your business than his business because it's just deemed a more valuable asset. Even though, yes, the earnings are higher, but we're also going to dial up the multiple a little bit too, because your earnings as a percentage of revenue are stronger as well. So people are chasing the top performers and they're chasing the bigger players. That's going to command higher multiple. So, deal structure, I'll get into multiples here in a minute. Deal structure, what can you expect? How much is going to be cash versus how much is going to be contingent? So I'll answer that by saying it could be anywhere from 0 to 100. And you say, well, how is it 0? There are some businesses that are just so messed up that a buyer is just going to say, look, I'll kind of pay you as the business performs. I'll pay you quarterly because you've got this massive customer concentration, you've been losing money. I'm still going to pay you something, but I've got to come in and do a lot of work in order to get it there. That doesn't happen a lot. It does happen, doesn't happen a lot though. And we see a lot of 100% cash deals. I mean, we've had half a dozen 100% cash deals in this space alone. But they were businesses that had very, very solid risk profile characteristics. Common, what she was like, okay, Mark, well, give me something I can work with. It's typically kind of 75 to 80% in this market right now. Sometimes a little lower, sometimes a little higher. But that's what you could generally plan on. More is obviously better. You're going to have some sort of holdback typically, and those are running at about 10%. What does that mean? You've made all these promises to me about, past liabilities. Those are all revealed. You've told me what you know, but there could be stuff that pops up post-close that we hadn't really planned about. You didn't know about, I didn't know about. So we're going to hold back a little money for that. That's pretty standard in any deal. Earnouts. So if I'm not going to get 100% cash and I'm only getting 20 or 25%, what do I have to do in order to get that other 20, 25%? So the different earnouts that you're running into, it would be generally one of these three scenarios. It's either going to be an EBITDA-driven earnout. So I bought a business that has $1 million in EBITDA, and in order for you to get your remaining payments, the business has to generate $1 million in EBITDA or better over, call it 1 to 3 years. That's the most common earnout range there is out there. The other scenario would be gross margin. So with the EBITDA scenario, so if you think about this, it's like, okay, so I've got to make sure the business generates $1 million in EBITDA over the next 1 to 3 years, but yet I don't own the business anymore. And so I need to still have controls to run the business. Otherwise, you as the buyer would come in and add all this additional expense that compromises my ability to make $1 million. And the buyer's like, well, shoot, I don't want to do that because I own the business. I want to do stuff with it. So now I'm handcuffed and I can't do anything with the business. So what parties will oftentimes do is move up to gross margin driven earnout. So you have $1 million in earnings, you had $2 million in gross margin. So that's what's the number that's going to drive the earnout. Now the buyer can come in and do whatever they want with the SG&A in the business. They can hire salespeople, fire salespeople, add back office, subtract back office, make investments. All of that noise happens below the gross margin line. The third scenario would be just a revenue-driven earnout. $1 million in earnings, you had $10 million in revenue. As long as the business generates $10 million in revenue in the next year, then you'll get your earnout, bless you. And so those are the three scenarios that typically are driving earnouts when they're in place in deals. Seller notes are less common. People talk about that. They're more common in those small transactions, $1 million and less, where an individual comes in and says, look, I want to buy a business. I'll pay you $750. I can give you 350 now, you take a seller's note back for 350. That's where they're more common. They're much more uncommon at the multi-million dollar transaction level because money's cheap and it's available from the bank. So you're not having to enter into a relationship with the seller in that type of complexity. If there is a situation where there is a percentage of the deal that's paid to you in the form of stock, some people, hear about, well, I'm gonna roll my equity into this transaction and I'm gonna continue to be active and I'm continue to own a piece of the new business. Those common ranges are 1 to 20%, and they're generally reserved for larger deals. They're not very common on smaller deals. Give you a little snapshot of what that looks like. So if you had a deal that your business was worth $10 to $25 million, a buyer comes in, and let's say it's a private equity buyer. The data says that about half of the money that they're going to get to pay you, they're going to borrow from Bank of America, senior secured debt. 10% of their money is going to come from a mezzanine lender, so it's just more expensive debt. 20%-ish is going to come from cash, from their money, from their fund, and 20% of it would be you rolling equity. So I'm not going to give you $10 million, I'm going to give you $8 million. The other $2 million you're going to roll into this new enterprise that we're going to grow together, and then we're going to exit together in 5 to 7 years. So the bigger the deal, the smaller statistically that percentage is. But so if you fall into the bucket of having a business that's worth more than $10 million, this is the kind of deal structure that you're oftentimes going to run into. So now let's talk about multiples. I'm actually going to move through the slide. I'm going to go on to the next one. I think this is more helpful for our group. So this is a really good snapshot that's pieced together through 2 different sources, one of them being Pepperdine survey that was done, and also another company that we work very closely with called GF Data, which takes a look at transactions that are 10 to 250 million in enterprise value. So again, it falls into that lower middle market category. So when you think about a business that has a check size of less than $500,000, chances are it's sold for a multiple of about 2.5 of its earnings. And that doesn't really change much for the $500,000 to $1 million transaction. People say, well, what do I need to do to get a 6 multiple? Well, you need to have a business that's probably worth, north of $10 million to start seeing a multiple of 6. And, people say, well, what do I need to do to get a 10 multiple? Well, you've got to have a business that's worth certainly well north of $50 million to even start thinking about double-digit multiples. And I would say it's well above $100 million before you start to see those type of double-digit multiples. Any questions on this? This is usually where people spend the most of the time pondering, but not necessarily asking until after the fact. So again, if you go back to the formula and you think about my business, what's it worth? If your business is making $500,000 a year, and you do that risk profile analysis, that's a business that's probably going to sell for anywhere from a 2.5 to a 4 type multiple for that type of business. But dialing in any more specific than that is really hard because the market, it's a very inefficient market to sell smaller businesses. So it's a long, arduous process of going out and seeking out different buyers and having a lot of discussions and getting a gauge of where the market's at. It's not like a home appraisal. Well, the last 3 houses sold for this much, but this one had an extra fireplace, so it sells for this much more, and that's kind of what it's worth. It's nothing like that at all. It's really what the market will pay. How are we doing on time? Okay, good deal. All right, so I'm happy to come back to that later on if we want to. So when we think about everything we've just discussed and whether it's the right time to do a deal or not. The good news is there's a lot of predictability to when's the best time to buy or sell. And right now, and this goes back, they started tracking this, at least for this report, back in 1980. So it pretty much runs in 10-year cycles, 1980 to 90, 90 2000, 2000 2010, 2011 to 2020. So what you've got is we're entering a period of uncertainty, where it's not necessarily, it's not a bad market. Here you've got a deal recession that turns into a buyer's market, but we are exiting the seller's market. We're still in it, just to be clear, we're still in a seller's market, but we are starting to exit, and we're starting to enter a realm where it's a little more neutral. And again, this is very predictable. What generally drives this is the cost of capital. Cost of money is going up. That generally brings valuations down a bit. Debt loads are higher. And again, that starts to cause people to take their foot off the borrowing gas a little bit. We've already seen signs of that, where people are saying, I intend to borrow less than I did in previous years. So, that borrowing volume is a result of these two things. And then this ultimately results in multiple softening. So you go back to these multiples. Doesn't mean these multiples are going to cut in half. So I don't want to paint a picture of extremes here. But these multiples are indicative of the current environment. And they will start to go down. And at some point in time, they'll start to come back up. So what to expect in 2019? First of all, we expect money activity to continue to be very positive this year. Baby boomers are going to continue to get older. They're going to continue to go to market. At least for 2019, we still expect tax legislation to be positive, at least at the federal level. I don't know what state you live in, but Illinois is not heading into a lower tax environment or a problem. Financial buyers still have a lot of capital to deploy. That hasn't changed at all. Strategic buyers are still active. A recent survey that was done by Deloitte of CEOs, the vast majority of them said we expect to continue and increase our M&A activity in 2019. So all very positive indicators for 2019. Buyers, when we talk to them and we ask them why they're doing deals, they're predominantly doing it to either expand their footprint. Because a lot of customers are saying, hey, if only you did work in Atlanta, I'd be able to hire you to do the work there. So that's a very common phenomenon, when we have national clients. So, or if you're offering some type of service that people are looking to expand in. The macroeconomic drivers are all expected to be very positive, at least through the first 3 quarters of this year. There's a lot of noise about potential fourth quarter shifts, potential drags on M&A. Certainly, the macro economy can put a drag on M&A. Rising interest rates can put a drag on M&A. But again, I don't want to negate what I said earlier, and that is businesses that trade at the size of like pavement maintenance companies for the most part, that activity is going to continue because of why they sell. It's not that it's all of a sudden going to come to a screeching halt. Wall Street very well may. Softening multiples, driven by rate increases and growing debt loads. And then lastly, just the overall statement is that 2019 is going to be a great year. Whether you're a seller and looking to exit, or you're a buyer and looking to do deals, there's still plenty of money out there to do deals. There's good businesses to buy, and it can be a great strategy if you're looking to move forward. So, with that, happy to answer questions that anybody may have and comments as well. I know there's some seasoned buyers in the room here, Gary, that if you have anything to add to the discussion. Yeah.
I was looking at, we're a pavement maintenance company, so, we're already starting to sell for the
upcoming season.
Yep.
And, we're like $1 million business, and we're already at probably 150,000 in sales that look like they're going to come our way. So when you're talking to a buyer about the business, where would that fit in, or how would that make a difference of what, you already have contracts for the upcoming season?
Yeah, so it's, because they're recording this, I'll repeat the question, plus also need to make sure I got it right. So the question, as I understood it, is that you have a pipeline of committed business that is imminent. You've got earnings on the books. How does that pipeline of new business factor into how the business is viewed from a value perspective? Yeah, so the first part of that response is every business that is sold has some pipeline. Buyers are going to be expecting that as part of their thinking about that multiple. So it wasn't up there as one of the variables, but there is an expectation. What do you have committed? When are you working? And that has to be at some sort of reasonable level. Otherwise, they'll actually dial back their valuation because the day after close, if there's no new dollars coming in, that's a problem. So what is the backlog is always a discussion that's had. To the extent that it's an excessive backlog, for good reason, all of a sudden you just have a surge of committed stuff. It's not because you can't perform the work.
This is pretty consistent for us.
Yeah.
We're at least 20%. I'm in the Philadelphia market, businesses for sale, but generally we have at least 20% on the books before we even open our doors on April Fool's Day is my magic date to open. But
right. Yeah. So backlog.
And that's been pretty consistent over the past 5 years.
Yeah. So that's something they're going to be looking at. Is the backlog the right number? Is it the right volume? So that when doors open, or if we close, 30 days from now, I can be sure that there's continuing revenue coming in. But to the extent that it's excessive, they're going to want to understand why, and is it sustainable?
Okay, so it's plus, but not not necessarily greater than.
Yeah, it's not going to move.
More effective.
Yeah, what it does is it helps the risk profile. It doesn't necessarily mean they're going to change their EBITDA calculation, but if you've got a really strong backlog, they're going to be a little more bullish, on a multiple than they're thinking about applying to the business. You have a question back there?
Yeah, we've done two street acquisitions the past.
Sweet acquisitions?
In the past year and a half, small.
Yep.
Acquisitions nonetheless. One of the companies called us and mentioned he was selling his company. The other, I tripped and fell over at a trade show.
Okay.
Outside of us being reached out to or tripping and falling, what other ways are there, say that we're considering a third acquisition to locate these companies? I know you mentioned biz, buy, sell.
Yeah, there's three ways, if you will, that you could source acquisitions. Well, it's probably more than three, but the three big ones would be, one, you could certainly go on some of these online exchanges, if you will, like Biz by Sell or DealStream. Another way is you could reach out to all of the local business brokers in the area. A lot of them are franchised and say, hey, I'm a buyer. This is the profile of what I'm looking to acquire. The downside to that is they're going to call you and everybody else too. So you now have put yourself into a competitive situation where you're going to be bidding against multiple people to buy a business. The third way is, you can engage a third party to just go out there and contact business owners in the space, kind of like a salesperson, but their job is to go out and start dialogue with business owners about their interest in potentially selling their business.
Now, is that someone that we would hire internally, or there's a service that's paid on results?
Either way. So some people do it internally. What we found is with internal M&A, a lot of times your competitors are reluctant to talk to you if they know that it's Mary or Bob calling from ABC Sweeping and their XYZ Sweeping, hey, we're interested in buying you, want to have a discussion, they oftentimes just immediately kind of shut down. Because as soon as they say yes, it's like, oh my gosh, the world's going to know. So a third party oftentimes are much more receptive to, saying, I'm open to having a discussion. Now you say, well, why does it matter? Because that third party was engaged by a buyer anyway. I say the same thing all the time, but for some reason they're always very willing to speak to independent third parties.
It's a perception thing.
Yeah. Gary?
Hey, Mark, is there any type of means, numbers that are used for the facility services businesses like paving, let's say, right? Let's say $1 million to $10 million EBITDA businesses that anything tracked out there that anybody could see or you could bring to their attention that, hey, here's the average of what a business like this is tracking at.
You're talking about earnings?
I'm talking about multiple EBITDA, value of a business, right? Is there anything out there to track as far as business sales of this size? Let's say $500 million to $10 million EBITDA businesses in facility service space.
So, are you talking sector specific? So if we go back to, so the question is there any data out there? And if you would have gotten here on time, I answered that question. But Gary's a friend of mine, I can talk to him like that. No, so when you think about trying to get good intel on multiples for businesses that trade in the private sector, not the public sector, it's very difficult because the transactions are not regulated. So you really have to rely on more reliable aggregators like Pepperdine and companies like GF Data that will look at the sector, they will look at the size of the business and look at all the variables and report out where the multiples are at. If you're looking for specifically the facilities or the pavement maintenance sector, that's when there's a lot of breakdown in even the big aggregators because there's so few deals that are visible, that are sizable in the space. There's just really not good data. But again, the good news is the variables that are involved in valuing these types of businesses are very consistent with many other companies in the business services sector. So services to buildings and dwellings falls underneath business services sector, which is squarely where we're at. So, even if we found and dug deep enough to find enough data, the consensus is you wouldn't really find anything different than this because of those deal drivers, which are really. It's really this right here. I mean, this is an asset-light industry. There's no big million square foot facilities to factor into the situation. There's just it's a mature sector. So those are all very, very predictable elements of valuation. Did I answer your question?
Yeah, I was actually here to do that.
Which slide?
I never figured out as well as I can, so thanks.
Sorry. Yeah.
Does owning your facility or the location of the facility matter at all?
Well, location of facility is usually a topic of discussion because they like, if you're in a major metropolitan area, they like to see you located someplace where you can get to a variety of different places. The ownership of your facility is buyers are really have generally no interest in owning real estate. So first of all, real estate is one of those things that if you get it, you could be potentially stuck with it for a while. So they do like the ability to come in and say, okay, I'm going to hang out at your offices here in your facility for the next couple of years. We're going to assess whether this meets our needs going forward. So if you're a $5 or $10 million company and somebody, a $100 million company coming in and buying you, they may have needs that will exceed what your facility will provide for, so they may not need it. But put it this way, we don't see many deals where the buyer is buying the real estate. They're agreeing to sign on to a lease for some period of time to lease it back from you, And then after that, they may just continue on with the lease, or they may go to another facility they feel meets their needs better. Yeah.
I came in about 10 minutes late, so I don't want to be in the same boat as him, so I hope we didn't cover it, right? But starting 5 to 7 years out, you're preparing yourself that far in advance.
Yeah.
What are probably the 3 to 5 most important things that you should do to your company coming up to your day?
Yeah, when you think about, well, we're doing business optimization type of engagements. There's certain things that you could start tomorrow, and within the next few months, will really improve the situation. There are certain things, if you started tomorrow, you may either never fix, or will take you years to fix. So when I think about 5 to 7 years, the two things I'm generally thinking about are the people in the business. That's generally a multi-year challenge. When I say multi-year, let's say, there is dependency on you. It's like, look, you really need a chief operating officer. You really need, 3 more salespeople in here because, examples, we're involved in a transaction right now. I met with the business about 5 years ago. Business is about $5 million in revenue. The owner generated like 3.5 of it. And the balance was a couple of other estimators. And I'm like, the business is going to be challenging to sell because you're going to be difficult to manage. You may not stick around. Poof, there goes $3.5 million in revenue. So over the course of the next 5 years, he hired a bunch of other estimators, and now it's about a $12 million business. And he generates, I think, about $2 million. So better situation. But that took many years. You hired this person, they didn't work out, hired somebody new, they did work out, but then they quit a year later. So to build a sustainable sales estimating team that's of the scale, to take the emphasis off of you, that takes a few years. But it really, it's people and client mix. So if you're like, I'm getting rich off of road paving and construction contractors because construction is booming, I would say that may not be the case 5 years from now. So I'd really start to look to bolster, that commercial work, that retail and HOA type work, something that's more sustainable, that's more based on relationships rather than low bidding, procurement processes. Those are the 2 big ones.
Could you discuss what the factors are and how you would evaluate when you're looking at a business that is either minority-owned or woman-owned, or both?
Yeah, so the question is, minority or women-owned businesses, how does it affect value? It affects who, so first of all, it may have no effect because we see businesses every day that have a WBE, MBE, or MWBE certification, and they have no contracts tied to that status. They went through the process, they got the certification, they went out, they met with a bunch of people, and it really did not matter. So in an evaluation scenario, that's fine, because all work is sustainable in the absence of that requirement in the contract. Now, if it were a situation where the work that was being procured by your largest clients was being given to you because of your minority certification, unless the buyer has the same certification, they are at risk of not having that recur as revenue. So it's certainly something to think about. So that means your buyer pool gets smaller. So we are involved in some transactions sometimes where we can only talk to, it's not so much in this space, but in some other sectors where there's more recurring revenue, monthly subscription-based type revenue, and ongoing contracts are tied to that minority status, that's when it becomes much more a necessity to have a buyer that has that same status, otherwise work goes away.